Continuing from my last video where I talked about the US national debt is now 119% of its GDP, let's take a focus on the US national debt in this video and see how it's related to the future of the financial world, where I see both the stock market and gold are going to crash just like crypto did since the middle of July. And hopefully by the end of this video, everything will tie together and make sense. So let's get started. So you may have heard from elsewhere that the US debt level is increasing every second, but in reality, you can go to usdebtclock.org to see this US national debt increasing every millisecond. So how did we get to this point? To answer this question, it may be helpful to pay a visit to the US Treasury's website. The US Treasury has a website called Understanding the National Debt, which consists of detailed explanations of how we got to this point. But in a nutshell, the government is just like a person with income and expenses. And the government's income mainly consists of income taxes collected from the US public, and its expenses mainly goes to infrastructure and social services for the public. But when its income is not enough to cover its expenses, it has to go out and borrow money to keep itself running. But when this happens repeatedly over time and its revenue and borrowings repeatedly goes to cover its expenses first rather than paying off its debt and the interest on those debt, we have a debt level that we see today. And this is just the same situation as a person who keeps paying the minimum balance. Most of you will call this person irresponsible, but that is exactly what the US government is doing and has been doing for the past decades. To look at the debt level and the interest expenses on those debts separately, it's helpful to look at the trend of interest rates over the past 10 years, as well as the debt levels during those years. And that is what this chart is doing here. So, looking at 2020 and 2021, we can see that although we have a spike in the government debt level, the interest rates during those years were so low compared to the prior years. The overall expenses on interest on those debt are not a big concern. But we are at an all-time high in terms of interest rates and the debt level today, and that is problematic in any debt management situation. And in mitigating the situation, we see that Trump has been increasing tariffs on imported goods because he cannot increase the income taxes from his own citizens who elected him. And he's cutting his own public employees because he cannot cut the social services and infrastructure spendings that are servicing the people who have elected him. As well, he has been pushing the Fed to cut interest rates, although that has not been working very well during the past few months because the tariffs would lead to increased inflation, and we shall see this over time. But this puts on big pressure on the Fed because during a high inflation era, it's very hard to cut rates to further boost the inflation that the public is facing. And the consequences of this could be devastating in the coming years. So we have been seeing that the Fed has been struggling in the rate cuts lately. And a further factor to keep this debt situation afloat is to keep having buyers of the US debt. And to achieve this end, it's necessary to make all other investment options less appealing than the US debt. Thus, my prediction of the stock market crash, as well as gold as a potential investment option for all potential buyers of the US debt. But this is just my opinion. Let me know if you agree or not.